Hello, everybody. Welcome to Wall Street Hackers, one of the most popular programs on the Pod TV network, where we broadcast out of the New York City area and across the world. My name is Nick Palavito. I'll be your host today, but I will not be the moderator. That will be Peter Bennett, who, for those who know, received his bachelor's degree in economics from UCLA, his law degree from the University of Miami, and his master's in business administration from NYU. They spent 17 years in Wall Street studying, analyzing, dissecting stocks. And so with that, he's going to give us some updates and tips, the stories of the week, the quotes of the week, the tip of the week, all from the great Tower of Power, New York City. So without any further ado, the Wall Street hacker himself, Peter Bennett. Peter, welcome to your show.
Nick, welcome to Wall Street Hackers 12/19/24. When you say dissecting, I think, sounds like a biology class. But I hate to say this in a way, but audience, I've decided to at least temporarily stop the regular Wall Street Hackers. And there are two main reasons why. Number one, the market has climbed, and we've done very well with our investments over the last 2 years. But the problem is it's climbed a lot, and that's a good thing and a bad thing. So I think it's in a precarious situation. Today, you could buy a 30-year bond at almost 4.8% with a high coupon. And I'll be talking later about, final allocations for the time being. But I've kind of dug in because I have no idea what's going to happen with inflation now. And I'll be discussing that in a little while. But that's the first thing. I just have a very consolidated portfolio now. I've shed a lot of things. I even shed utilities recently, which are supposed to be safe havens, but I saw they were going down. And, the real question in any investor's mind has to be, is inflation under control? Where is it going? And I can't answer that question, but I certainly have worries that it's not under control. The second reason I'm doing this is I created a report called A Pathway to Fiscal Stability. And I believe it's the most important financial report of the decade. And it deals with substantial and many innovative ways to deal with the debt crisis. And it's focused a lot on Social Security and Medicare. And you don't hear a lot of, you do hear solutions about Social Security thrown out there, but especially about Medicare. I think I have a lot of innovative solutions. And so I plan to work to promulgate this report in Washington, and that's going to take some work. I hope somebody's going to pay attention to it. They really should, but we'll see. So if you are in Washington and have power, or somebody who is powerful, I'm going to give you my spare email address. It's not my regular one. I'm not giving that out publicly. But if you were to contact Peter Bennett, NNTT, BENNETT 8 @yahoo.com. So it's Peter Bennett with 2 N's, 2 T's, 8 @yahoo.com. If you know somebody who would be interested, if you've been maybe watching Wall Street Hackers and you see the predictions we've made, and we've been pretty accurate at forecasting for several years now, about 2.5 years, not just in terms of investments, in terms of market events. And I will throw in, even more as a side thing, I wasn't going to mention this, but a lot of the mainstream media is just tanked now in terms of their ratings. And I've been criticizing them for years for being so one-sided. But we'll see. CNN just reported 73,000 viewers in their prime, I think it's 18 to 54 slot. I mean, that is a disaster. 73,000 viewers. I don't even know if I have that many, but it's not great for them. Anyway, so we'll get to the markets report, and then I am going to leave you with the final allocations that I have right now, and I'm dug in with these. And, so hopefully that will take you through, give you some guidance for the future. So the markets report, just as Wall Street Hackers predicted, the market was delusional about falling interest rates for 2 years. And then finally we said, well, we think they are going to fall, and they did fall. Now we think that the market is probably still delusional about inflation being under control, a soft landing. it's the same thing we've been talking about, but unemployment is still near historic lows. There are maybe 8 million unfilled jobs in the United States. Government spending is totally out of control. And the Biden administration just spent everything they could, and now they're spending everything they can on the way out. And there's an unfathomable U.S. debt. We've been one of the, not only, but one of the few people shows saying it's not 36 trillion. You hear 36 trillion every day. The national debt, as the Post just came up, is 125 trillion based on David Walker's estimates, which are much more realistic. He was the Comptroller General of the United States under 2 presidents and asked to serve in important positions under 2 other recent presidents. And so you have to count your unfunded liabilities as part of your generally accepted accounting principles basis. So this is a lot of uncertainty. And I'll be getting that into a minute, but today you could buy a bond at almost 4.8%, a long-term bond. So that has to be putting some pressure on the market, and I think it will. If that's the thing, if rates go higher. So I might as well get into the next discussion, which is what to do. Our allocations now. First, Wall Street Hackers is for entertainment only, as you know. Hopefully, you've been entertained. There are no guarantees on any of our suggestions. These are only our opinions. Consult your financial advisor. So certainly every investor has different goals, different time frames, different tastes of risk. I'm being a young over 65 investor because I don't ever think of myself as 65. Or over. And given the market's issues, the environment, I'm less interested right now in growth and very interested in avoiding risk. But on the other hand, there is that no risk, no reward. So we're taking some risk, but they're calculated risks. So here's what I like. Well, I'm starting with the largest allocations. And I'm not being too specific today because, again, everybody has different tastes, and I can't guarantee anything in this market. But this is how I'm playing it. So first of all, as I mentioned, long-term high coupon treasuries. Treasuries are always a ballast for the portfolio. If you hold them to maturity, you can't lose money. Warren Buffett's rule, lose no money. But right now, if I get a 4% long-term treasury, my theory is this: the markets either have to go, the interest rates and inflation have to go up, down, or stay the same. That is a safe bet. So if the governments of the world, as I predict they will, use yield curve control eventually when they figure out they need to bring interest rates down to zero because of the massive debt they have. And we've discussed that 125 trillion is more than the U.S. stock market, the U.S. bond market, and this is just the U.S. debt of 125 trillion. U.S. stock market, the U.S. bond market, all privately held real estate. And now I can realize I could throw in all commercial real estate in the United States, and that's coming close to 125 trillion. When they realize that, they're going to say, we can't keep paying interest on that. Interest is already eating up more and more of the budgets anyway. So the point is, I figure if I'm getting a high coupon, 4%, let's say, if rates come down, those bonds will be worth a lot. Plus, I'll have the steady cash flow like a pension. If rates go up, at least I have the steady cash flow to keep reinvesting at higher rates. Now, it won't be a great investment in terms of the principal, but the other side is if rates keep going up, a lot of things are going to tank. If rates go to 5 or 6, and by the way, T. Rowe Price came out with a prediction, which a lot of people don't agree with, but they said they are predicting 6% interest rates. And that would be devastating to the market because that's a substitute for the other investments, one. And two, if rates go to that high scale, then companies are going to be hurting. A lot of leverage companies are going to be really hurting. ETFs will be hurting. A lot of things are going to be damaged by that. So treasuries, you hold them and you keep counting the coupons, and you can reinvest at whatever the rate is. And finally, if things just stay the same, which is the only other possibility, well, all right, I got my 4.5%, 4.8%. I put a tiny bit in today because I had a tiny bit to buy. But whatever it is, I just get my income. It's sort of like a defined pension, and I can just reinvest the cash flow and see what happens with the market. And the second thing I like is cash, and I have not had cash for years, but now I don't have a problem with cash either. At least watching for a while. I put my free cash in an investment called BIL, which is the Bloomberg Spider 1 to 3 month Treasury bill ETF. Very safe treasuries, and it's yielding about, I think, 5.1 now. So instead of leaving your money getting some measly rate as some of the brokers pay or some banks, you can move in and out of there often. And I often did that trading. It's like, okay, I have some money, I'll put it in there, then move it out on a daily basis if you want. And 5% is pretty good rate right now, to say the least, while you're waiting. 3, of course, is our old favorite, MPLX. Still like it. I'm not as aggressive as I was years ago. I was saying, we were saying 20%, maybe more, 25% MPLX. I was hedging some of that with options, but basically I was saying it was unbelievable. But that was when it was at 13 and 23 and 30 and 40. Now at 47 and 50, I still think it's a good place to be. If you want to take any risk, that's where I am taking my risk, in one place. So it has a dividend still around 8%, which is tax favored for U.S. investors. You do get a K1. It has a price to cash flow of 8.65, and that's an 11.5% cash flow yield. And with these MLPs, you have to say, well, that's 11.5% cash flow yield with all the growth investments they're still making. If they decided, they could stop. But also under the Trump administration, I think there's a lot of opportunities for new pipelines. So the other thing about it, like MPLX, much more than most of the other pipelines and MLPs, is it's very oily. I believe it's about 65% oil based. And I don't like NGLs, particularly natural gas liquid pipelines, because I believe, I've looked at this, and there's a lot of issues, I believe, coming up with that. One, Europe is using less and less of that, and I think it's going to keep continuing to go down. 2, there's so all those pipes going down to the Gulf, what are they going to do with the gas? Well, they could say natural gas liquids. They could say, well, we'll send it through the canal, but the canal has been very dry. So the problem there is they can't get as many ships through the canal as possible to try to get it to Asia. So now you have not only that, but also 2 pipelines going in that are going to be feeding the West Coast demand, in other words, Asian demand. One in Canada and one goes down to Mexico. So now there's a lot of competition for that Gulf natural gas, and it may be trapped there. I did talk to him. I actually called the MPLX and Investor Relations and asked them about that issue, because I'm interested in that. And they said they didn't indicate exactly, but it sounded like they have a fraction of a fraction in the NGL market. And with those ratios, I'm not too worried about it. Next investment, now these are smaller investments. I have about 0.5% for the next 2. KRP, Kimball Royalty Trust, long-term investment, been very good, solid. It's an 11% dividend. It owns huge tracts of land in the United States. Now, the key word is land, so it doesn't have to go out to the middle of the ocean to get its oil and natural gas. Do I love it right now? No, because I'm concerned about the natural gas liquid, but it has a good percentage in oil, and it's paying an 11% dividend. So, you know what, if it drops the dividend to 9, if oil prices go down or whatever, as long as oil stays reasonably high and natural gas doesn't totally crash, then it should maintain a very high dividend. And it's also a hedge against everything else, because if inflation kicks up, oil prices could be going up too. It takes a lot of, there's a lot of expenses in extracting oil, obviously. Another one, which is a new one that would have been my dividend pick of the week, is Google. So it's now my favorite tech play. I did like Amazon, and I still think it's probably okay, but I see more risk there. But the thing is, to ride this storm out, if there is one, I like Google, just again for 0.5%, because I'm risk averse. But one, it has so many diversified, successful businesses, even if it gets broken up. But the other thing is, and this would have been the interesting story of the week. It is so interesting. They have developed what's called a quantum chip, which is for quantum computing. I just learned about this myself. So Google says, and by the way, this is not available yet commercially, but it will be maybe in the next 4 years, but they've got it, whatever it is. I said 4 years. I don't know, 4 or 5 years, whatever it is. But you're ready for this? So Google says that their quantum chip can do a task in 5 minutes that would take the world's fastest supercomputers longer than the age of the universe to accomplish. Once again, they do in 5 minutes what the world's supercomputers would take the age of the universe to do. That is a quantum leap, I would say, to make a pun. That is unbelievable. It has all kind of implications, first of all, in medicine and possibly in human longevity. So we will see where that goes. But if they have this, and it sounds like they do, then they are so far ahead of probably all the competition. So 0.5%, no problem. And any of these investments, maybe when I think the storm is past, if there is one, maybe early next year there will be one, and maybe not. Maybe the market will keep going up. I can't say anymore. That's a problem. But I like 0.5% in Google right now, if that's where I'm willing to take some risk. Another place is gold. I'm 1.5% to 2%. I've been all over the place. Gold, you would think, is a great hedge against inflation. And if you looked at the 70s, it was the best place to be. Gold miners, even better than gold, but both fabulous investments. But that created a myth that gold is a great inflation hedge. But it's a strange thing because you would think, well, inflation goes up, gold goes up, but there's an interest cost to carrying gold. And so a lot of times it doesn't correlate that highly if you look at the correlations. But again, diversification in an environment where you're not sure, 1% to 2%. If it doesn't go 1.5% to 2%, if it doesn't go anywhere, I can sell it later. It'll still be worth something. But the other side is if I see inflation kicking up, it may be a big flight towards gold. So we'll see about that. In the long run, to sum this up, I would say that, again, at some point when I think it's safe to come out of the water, and again, it may be now, but I'm going to go back to the philosophy we've been using for years, and which is historically proven to be by far the best one, which is dividend stocks and dividend growth stocks, number one. Why? For so many reasons. One, you get some cash flow in case things go against you. You're more likely to hold it. But I had 2 studies, one 20 years and one 100 years, where dividend stocks and dividend growth stocks just blew away the S&P 500. One study, a Hartford study, showed that the 20 years to 2022, dividend stocks and dividend growers outperformed the market for 20 years by double and triple. So I'll stay with that. And also REITs have historically outperformed the market. Energy stocks have definitely outperformed the market over time, over many periods and generally. And MLPs during many periods have way outperformed the market. So that's why I'm staying with MPLX, and maybe I'll find another one I like that much, but I don't know. So we have our panel discussion of the week, and we actually have more time than usual. For the years, we've been running like 10 seconds left, 20 seconds left. We don't have time to finish, but we're bringing in Nick and Mark, my great co-hosts. Hello, Mark. So I'll do a sort of quick run and a background, and then we'll get into it a bit. Yeah. It's an interesting topic because it affects the market so much. So the question is, will the government ever solve the debt crisis? I guess going with that is, what do you think is going to happen? And background. So this is my report. It's called A Pathway to Fiscal Stability. I actually credit David for giving me I had the pathway to fiscal stability, David Walker. But it's a fiscal pathway to fiscal stability. It's I learned from David actually that the best report size is 30 pages for a a government report. He said you can go to 50, but if you go over 50, nobody will even crack it open, which makes me wonder as a side, what happened with all those big budget bills and reports? They just say, it's too big, throw it out. Anyway, so I'm going to read a few selections from that as my background because I had already done the work. And we have a fair amount of time. Okay, so chapter 1, now or never means now. Asked how he went bankrupt, one of Ernest Hemingway's characters famously said 2 ways, gradually and then suddenly. One difference between government and a consumer is government can be effectively bankrupt and not know it. Again, these are just selected paragraphs from the different pages. The United States is not just in a Medicare and Social Security crisis. We are in a whole government crisis. But given the size of the Medicare and Social Security retirement unfunded liabilities, these will cause a breaking point or a fiscal endgame for the United States. Even worse, even if the crisis didn't exist in the United States, the world is in an almost exactly similar situation. A very large number of countries, 73 countries in all, including many throughout Europe, Asia, and South America, offer effectively free healthcare and have aging demographics and have both severely underfunded healthcare and retirement systems. Chapter 2, what is $125 trillion? Well, actually, I told you what it is. It's more money than the U.S., and that's just the U.S. debt. It doesn't count other corporate debt. It doesn't count pension debt. It doesn't count the world's debt. And it's more than those four markets I mentioned. All privately held real estate, all commercial real estate in the United States, the entire U.S. stock market, and the entire U.S. bond market. It's almost unfathomable. Going on in that chapter, the 36 trillion debt figure often discussed in the media and by financial analysts isn't even close. And yet even the current debt is starting to cause notable strains on the system. According to recent data, 74% of the federal government's budget is considered fixed or mandatory spending and interest, meaning it is predetermined by law and does not require congressional approval, with the majority of this amount going towards programs like Social Security and Medicare. And I will add, the Trump administration is inheriting a fiscal disaster, and they're going to help by cutting expenses. That's the first step. Cut waste, cut regulation, but that's a lot of debt. Chapter 4, historically, Republicans have been predisposed to view budget issues with an outlook to cut taxes to stimulate the economy and supply, and Democrats have been predisposed to view budget issues with an outlook to increase spending, to increase demand and wealth equality. Neither approach is wholly wrong, but neither approach is now sufficient. Given the $125 trillion in debt, we have to use every available tool to prepare. And finally, I'll go to chapter 11, conclusion. So people and politicians talk about the need for unification, but it hasn't happened in a long time. We are ultimately one people, and in the pathway to fiscal stability, we need to have one purpose and to act immediately. This debt crisis is growing by the day, and it is definitely not going to simply disappear. So we have about 7 minutes. Nick, you want to take 2 minutes, and we'll give Mark 2 minutes, and I'll take 2 minutes.
Yeah, my opening statement is that we're in a heap of trouble. But let me tell you why, because there's some precedent for this. Okay, and here's the precedent I'm getting when I'm over in Spain. It's a country called Argentina. And Argentina had this in 2020. Their debt to GDP ratio was 86%, which is actually better than the United States debt to GDP ratio, which is right now a little over 100%. And then in 2 years, because of their spending habits, their debt to GDP ratio jumped, you'll love this number, to 155% of debt to GDP, which means they're just spending a lot more than they're taking in. But let me tell you what the result is. Remember, this is not our country, this is Argentina. The result was 10% inflation a month.
A month?
I said, a month.
Wow. I have heard that inflation, but that's
you
crazy.
You haven't seen anything yet, but I will tell you, I've met a lot of young people from Argentina here in Spain. What are they? I asked, what are you doing here? He said, our country is a mess. Okay. He said it's corruption, it's inflation, you can't get anything done. I mean, basically a beautiful country that turned upside down within a period of 2 years. There's absolutely no question, because this happened in Argentina and Venezuela, that this could happen in the United States. So here's the prognosis. If you continue, your debt increases. Now we're already over 100%, but jumps to 155%. Then you're going to experience this, about 10% inflation per month. And this is going to be very hard to manage.
You think that'll happen in the United States?
Yes, it can happen in the United States. There's
it can, but
as one of my medical doctors said when he found out I had a high BMI, he goes, you know what? It's universal. You're not immune just because you're in the United States. So with that, that's the problem in a nutshell. And that's the future. If you want to look at it. Remember, we've
now
had
I have
high
to follow up with a
inflation
question, Nick, because that's a point in the question. The very one point is Argentina did go socialist, and now they've gone back towards capitalism. Socialism has never worked historically, except for people look to the Netherlands, and they're not even that area, and they're not even that socialist. And they have a lot of natural resources that are unusual. But Nick, I don't know if you know the answer to this, but how do you invest if you think that, if you think there could be even 5% inflation a month or 2% inflation a month? I mean, admittedly, my treasury is at 4%. I'm not going to lose the money, and I can take the money and invest it. The rates will be at, who knows, 40% a month, but it's still, how do you invest for that? Or do you just keep it in?
You go to countries,
treasuries?
Peter, it will simply go to countries that do not have high debt to GDP.
Oh, I see. You just migrate out of the United States.
Right. You just don't invest in the United States.
So here's your problem with that, Nick.
Pardon?
I haven't looked at Spain particularly, but I've looked at countries. I think I have. I've looked at countries all over the world. You think England or France or China or Spain or India or South America, Brazil are immune to this? They are offering free healthcare with aging demographics. They offer more free healthcare even to seniors than we do. And they have put no money away. And they have, I looked at the underfunded pensions. So where in the world you can go, we can't go to the moon. And I'm not sure that Europe's going to be any safer. And also, if the United States starts collapsing, we have a very tied world economy. The United States stopped buying things from Europe. They collapsed on that alone.
But there's Singapore, there's Monaco, there's other countries that are available.
Okay, Mark's turn, because we're
running out of time, and I was actually going to go to another part of the world because apparently they addressed this issue and everything. Because y'all know I tried to bring world perspectives to a number of these conversations, and they're saying that the paradox of plenty in Africa, not even the U.S., is visible as it is frustrating because they have a lot of things that I know we've been talking about we're going to use even here in the United States, which is natural resources. So
you're right about that.
In town endowed with immense natural resources, but they're burdened by poverty, hunger, and unsustainable debt. So they said that 90 billion. So we talk about how much money escapes in America, escapes Africa through illicit financial flows, funds that can transform healthcare and the infrastructure. And meanwhile, about 282 million people remain undernourished, and more than half of the nations face debt distress as their internal debt.
Wait, let me understand what you're saying, Mark, because I have to clarify. Are you saying you could invest in Africa, or are you saying Africa is going to even have bigger problems if the United States starts having issues?
I'm saying that we should invest in Africa, and we should need to do some more trade with Africa, and that could be part of what we can do is create some relationships with there, because they're having their own problems.
Oh, yeah.
Their external debt climbs past $1 trillion, and that's with the various nations, and they just had a African economic conference held in Botswana around Thanksgiving, so November 23rd through the 24th, and a lot of the leading economists and researchers were looking at ways that they could have practical solutions to turn Africa's wealth into prosperity for its people.
Well, okay, so let me take the last minute because we have 1 minute left, roughly 1:05. So, Mark, you made an interesting point. First of all, I don't know how to invest in Africa exactly, but I do know China's been very smart, and they've established all kind of relationships with Africa, and they're lending money to Africa and helping Africa, because that's where a lot of natural resources are in Africa now, and a lot of growth could happen in Africa. So it's interesting. Maybe I'll pursue that. So we have about 40 seconds left.
You might want to pursue that. Just
wait. I've got to close the show.
Close that.
So first of all, thank you, Mark and Nick. You've been awesome moderators, and Kim, who couldn't make it today. It's been a pleasure visiting with you, audience, and we may be back or I'll show up on some other pod TV shows for sure. And so I'll close with, as Kim always said, and maybe it was the best advice of the show: get healthy and get wealthy. Your health is so important; it's half the battle. Wealth is important too. So hope to see you again. Thanks for watching Wall Street Hackers. Bye-bye.